Hi, welcome to MainStreet Macro. I'm Neela Richardson. Recently, the Federal Reserve decided to raise interest rates for the ninth consecutive time. As Chair Powell was making his press conference, I noted something key that he said. He said that financial conditions had tightened recently and, quote, worked in the same direction as a rate tightening. Well, that caused me to want to dive deep into three essential questions. One, what are financial conditions? Two, why are they important? And three, what do they mean for Fed policy? Let's start with that first question. What are financial conditions? Well, you can measure them in a variety of ways, but let's focus on some key features and key metrics. First, one of the most key metrics is interest rates on government debt. So, whether that debt is really short term, like 3-month treasury bills, or very long term, like 30-year treasury bonds, these government interest rates really affect interest rates throughout the economy. Now, a second way, a metric of financial conditions is the overall exchange rate. Basically, how many of these it takes to buy one of these. What is the exchange between a euro and a dollar or any major currency? And I actually looked this up right before I started talking to you today. It takes almost uh, 11 of these to exchange for one of these right now. The third important feature of financial conditions could be in equities themselves. So think of your favorite stock or basket of stocks through an ETF or mutual fund. What are the prices of those stocks? Those prices are part of financial conditions and they can go up and down. So all of this added together affect the lending in the economy for consumers and businesses, which lead to the second question that's really important is why are financial conditions important? Bottom line, they affect the lending conditions of businesses and consumers. So that means for home buyers, they're a big determinant in mortgage rates. For companies, they can affect small business loans or even bigger business loans. For multinationals, they affect import and export prices. And when financial conditions are really, really loose, it means that interest rates are cheaper and credit is more available. When financial conditions are tighter, interest rates are higher, and that increases the lending costs and borrowing costs for all market participants. Now, the final question of importance is why financial conditions affect Fed policy. Well, as you can imagine, the looser the financial conditions are, the cheaper it is to borrow, the more likely consumers and businesses borrow to spend and to invest. That can be great for the economy, but too much of it can actually trigger inflation or keep our already high inflation high for longer. Now, if on the flip side, financial conditions are too tight, it can actually reduce all of that spending and investment and lead the economy to stall or even shrink. And so that leads us to the reason why the Fed is watching financial conditions so carefully. They're watching it to make sure that their interest rate policy doesn't tighten the economy too much or that financial conditions don't remain too loose and keep inflation higher for longer. But financial conditions isn't the only metric they have to look at. It's also labor market conditions and consumer sentiment and behavior. In fact, each and every time the Fed raises interest rates, they have to look at a whole host of economic measures. Financial conditions and whether they're loose or tight for the Fed is not an end in itself. It's a means to what they really care about, and that's tame and stable inflation and a fully employed labor market. Thanks for watching the Main Street Macro. For more information on the relationship between financial conditions and the labor market, please check out adpri.org.